Welcome back to the Americas Zone of the Investor Summit of the Singapore FinTech Festival. I'm Glenn Van Zutphen, hosting you on the Global Common Channel. So glad you're with us again today. In this next segment, we're going to look at FinTech mergers and acquisitions globally and discuss how the pandemic has affected these activities. Here to share their thoughts and highlight case studies on recent acquisitions, our Chief Executive Officer of Barclays Ventures, Ben Davey, Matt Dill, Head of Innovation and Strategic Partnerships at Visa, and Managing Partner of March Capital, Sumant Mandal. The panel will be moderated by Jonathan Weiner, Venture Partner at Oak HCFT. Let's go now to Jonathan and the panel to better understand the effects of COVID-19 on investments and acquisitions today.
The name of this session is the COVID effects on investments and acquisitions. My name is Jonathan Weiner. I'm a venture partner at Oak HCFT, which is a $2 billion venture fund that invests in just two sectors, FinTech and healthcare. Personally, I've been a venture-backed entrepreneur in the payments and processing space for the past 20 years, with multiple exits to companies like TSYS and Google, and was also the founder of Money 2020, along with some other leading event properties. Before we get into the introductions of the panel, I'm just going to give a brief summary on the actual facts and figures that COVID has had on funding. So as we all know, COVID has devastated many businesses and lives, but the VC market has been amazingly resilient during this period. While there was an initial slowdown in funding markets rebounded pretty dramatically. The pace of new investments did slow to about 71% in the first half of 2020 compared to last year, which is actually better than what happened in the last two recessions. But the industry has recovered quickly. Global investment funding hit $71 billion in Q3 of this year, which is up 9% versus Q3 of 19. And year-to-date total global VC funding is $205 billion so far this year versus $282 billion from all of last year. Overall deal counts are roughly in line with recent years, but we've seen a divergence with a slowdown at the earliest stages and an acceleration at the late stages on the back of massive VC mega deals. Global early stage deal volume has fallen by about 35%, and financing volume has fallen about 18%. But globally, mega deals account for 61% of all funding dollars. Almost 70% of all US funding volume in 2020 has come from mega deals, which is up from 43% in 2019 and 16% if you go all the way back to 2016. So COVID has also accelerated the adoption of technology in the FinTech sector across many subdomains, most notably e-commerce and payments. This is reflected in global investment volume within FinTech, which is actually on track with 2019 numbers, despite the dip in Q2. So there has been $32.4 billion in investments through Q3 of 20 versus $34.3 billion through Q3 2019. So the numbers are essentially on par from last year. And COVID has been a real accelerant to further digitization of consumer payments as individuals look for safer and more convenient ways to pay. US e-commerce sales, for example, was 16% versus brick and mortar pre-COVID, but in the 8 weeks following US lockdowns, it skyrocketed to 27% penetration. And the rate of this increase had previously taken a decade to achieve. The public markets are also recognizing and rewarding the value of the next generation of FinTech innovation during COVID, as businesses and consumers were forced to move to online digital-first platforms. Digital-first FinTech companies have been trading up 147% since the start of 2020 versus traditional legacy financial services companies, which stock prices essentially have been flat at around 1.5% growth rates. These legacy companies have traded at an average multiple of 8 times versus 30x for new FinTech companies, representing how investors believe these digital-first trends are here to stay. So, okay, with that, I'd like to go around and have the panel introduce themselves and talk about your investment theses at your respective firms and to make some brief comments around your own experiences on the COVID effects within your own organization. So why don't we kick off with Sumant, then Ben, and then Matt can go.
Great, thank you, Jonathan. Thank you for having me here. Good morning or evening or afternoon, depending on where you are in the world. I have been an investor in technology now for almost 2 decades, for 20 years. And my first experience with FinTech was a little company called Confinity that became PayPal. And we were very excited when we sold it to eBay for almost $1.5 billion in the early 2000s. So long history with FinTech and seen many cycles up and down. I started March Capital about 6 years ago. We're about $1 billion under management, and we invest in enterprise software, FinTech, cyber, all the stuff that businesses buy from technology companies, very little consumer. One of our investments is a company in India called BillDesk. Matt, I was speaking with the Sons the other day, he was a good friend of mine, and happy to have you as co-investors in that company. Now, COVID, when it hit in March, was a little bit of deja vu from the 2007-8 timeframe, if people remember that. And we all went into a little bit of a panic mode, told our companies to tighten their belts, et cetera, and we're expecting the worst. But what we've seen is it took about 60, 90 days for things to stabilize. But what we've seen in our portfolio is that companies that are delivering value to their customers from the cloud, that are delivering automation, digitization technologies, have seen their adoption cycles actually accelerate, dramatically accelerate, have done better than planned. And so in essence, what that has also meant is, as Jonathan was talking about, venture dollars, for companies that are showing momentum, it's never been a better time to raise money, whether it's in private markets or public markets. And we see that in public market comps as well. So FinTech, and as you rightfully said, payments, as part of this digital adoption cycle that has been accelerated, has done incredibly well. And our companies, whether it's in financial inclusion like EarnIn, or it's in fraud prevention, we have a company called Forta that's doing e-commerce fraud prevention, or even companies doing logistics and supply automation, they've done really, really well through this period. And we don't think that goes back to what it was a year ago. I think things will stabilize, they will normalize, but this new digital curve, adoption curve, is here to stay. So for us as investors in technology, it's been an interesting sort of watching the world sort of melt around you, lots of pain and human tragedy, but world of technology is accelerated like never before. Back to you, Jonathan.
Great. Yeah, so Ben, why don't you just give some brief introductions?
That's great. Thanks, Jonathan. So thank you, everyone, for joining us this afternoon. So I'm Ben Davey, the CEO of Barclays Ventures. This is a capability that we created about 2.5 years ago. And think of this as a combination between a company builder and a CVC. So the idea here for us was that we would have a small group within Barclays looking forward in time 4 or 5 years, thinking about the new technologies, the new capabilities that we as a firm and our partners should be testing, experimenting with, and create an experimentation zone essentially to test those ideas and test new business propositions and indeed new business models. Prior to that, I was group head of strategy at Barclays, and prior to that, an M&A and FIG advisory banker. In relation to the investment thesis, we are very much a strategic investor. So what we try and do is look at the themes that we've identified, the areas that we want to explore. And then we'll do one of 3 things. We will either build organically, or we will build in co-development with partners, big or small, or we'll work completely outside of Barclays with, generally speaking, technology companies, again, of any size. But where we have that alignment, be it through co-development or working with partners, we would, if supported by the appropriate commercial and business case, then look to take a minority stake to align interests and obviously share in perhaps some of the upside that we would hope to create as we help our partner deliver on their business plan. So that's broadly our investment thesis. In terms of the COVID impacts, look, they've been obviously far-reaching for everyone. I think the first thing we saw was really quite a dramatic focus on the near-term priorities. And so, as I'm sure with many viewers, be it founders or indeed corporate executives, we've been working out a much shorter book of work, but making sure that we get that done as effectively, if not more effectively, than we would have done in the past. The second thing, I think, has been to more willingly embrace and accelerate the pace at which we've adopted partnerships and technology. Goes back to the themes, I think, that you've already been discussing. And we have seen some fabulous examples of, in particular, partnerships around cybersecurity, partnerships around data and data analytics, as well as a number of areas that are allowing us to get deeper insight on customer experiences and needs. That feels to me certainly a very positive benefit of a somewhat difficult and challenging environment for many. So Jonathan, on that, perhaps just hand back to you.
Okay, Matt, you're up.
Yeah, great. Thanks, Jonathan. Pleasure to be here. I guess as a longtime Singapore, family, we're great to be back, even if digitally. So first up, I guess background, Matt Dill, I lead digital partnerships at Visa, and that really runs the gamut. That goes all the way from big tech partnerships with names everyone would understand, Apple, Google, Facebook, into long tail FinTech partnerships. And we run a programmatic approach that engages, well over 1,000 companies worldwide across all 5 of our regions. From an investment standpoint, Visa is what is called a strategic investor. That means that we're not allowed to lose money. I don't think we would, our CFO wouldn't come in and express joy at being called strategic if our portfolio wasn't performing well. So we obviously have that obligation. But generally speaking, our goal is to really extend the concentric circles or the reach of the network. And there's really 3 things that we look at to do that. The first one is because we can see a lot of payment activity going over our network. We look for sparks. We look for things that are different and are growing quickly. And it's our job to kind of pour fuel on that fire and to help those companies grow. So that's one place where we might invest. Another thing that we do is we look for what I would call sort of lighthouse brands or lighthouse examples. If you look at things like buy now, pay later, or new money transfer models or wallet models, there may be a variety of things that are sort of new experiences. And when we see a single company that we think is doing particularly well, we might invest to learn more about the category to make our network more compatible. We try not to pick a winner, but we do try to pick a company, learn from, and then scale the learnings, for all other companies in the category. And then the third thing that I would say is maybe a little bit different is we look for air gapping. When we see a problem, a place where our network is not able to reach or we aren't able to provide a service, we think we might need to fill in that hole. And a good example might be looking at the bill payment examples, that were referenced earlier. It might be looking at cryptocurrency, might be looking at buy now, pay later models, things where we can make an investment and we can go further into the ecosystem and eliminate that sort of white space. So those are sort of the things that we look at. To give you a little bit of sort of flow, we probably do about 15 investments a year. We look at about 150 different companies at any given time. The early stage investments are $3 to $5 million. But we may go all the way up into multiple $100 million, and our acquisition capability goes up into multiple billions of dollars. So that's a little bit of the scale that we've got. Pivoting to where we are today, Jonathan touched on it. The COVID pandemic has created a lot of hardship for people and businesses, but it has accelerated sort of the secular trend toward digital. And just to put it in simple terms, we look at our network, our volume year over year is relatively flat, but what makes it up has changed dramatically. And I like to say, it's not exact, but I like to say that face-to-face physical transactions drop back to 2017 numbers, and digital numbers jump forward to 2023 numbers. And so when you combine that, you're beginning to see a new makeup, and that's what leads to, I think, a lot of the interest in the companies and the categories we're going to talk about today. Jonathan?
Right. Thanks, everyone. So Now we're gonna try to have a little fun and get a little competitive in this panel. We're gonna try to make some audience participation as interactive as possible. So what I'm gonna do is I'm gonna ask all the panelists to pick the one major theme area within FinTech for 2021 that you're most excited about in terms of investment. So after each panelist goes, any other panelists can challenge and debate them on their topic, right? This is competitive. Since we can't do audience polling, I'm gonna ask everyone that's watching to go into the Q&A link and sort of agree or disagree with the themes and give their input, and I'll have a look at that and I'll declare a winner at the end of the session. So this time we'll kick it off with Ben.
Okay, thank you, Jonathan. And okay, voting buttons ready. So look, I can tell you in advance, the rest of the panel were devastated when I said that I was going to pick the theme of artificial intelligence for 2021. I feel that they already recognise they're on the back foot. So why is that the theme for 2021? Well, look, it's been talked about for a long time as being this game changer, this opportunity to outthink the humans, to sort of really understand customers perhaps better than ever before. And what I would say is that whilst I truly believe that that capability exists, it's not yet really, I would argue, been demonstrated at true scale, certainly in what I would call more mainstream banking. And there are some very good reasons for that. First and foremost, obviously, the data sets in question need to be well organized. They must, of course, be protected with the appropriate consents and security mechanisms. Secondly, they need to be searchable, they need to be labeled, you need to get over, obviously, the cleansing issues that exist. And that's taken a lot of time. But at the same time, when you're running your AI and related algorithms, of course, you need to be able to do them transparently, ethically, be open to challenge, and at the same time, then be able to show that the outcomes are both rational, but also sometimes demonstrably beyond what would otherwise have been considered the norms. And I don't think that has yet been demonstrated at any scale in the more, at least, traditional industry players. I think that's going to change in 2021. We have, I think, much more organization around our data. We have a much more uniform approach to privacy and protecting individuals as well as corporates. We have, I think, now demonstrated, at least in experiments, the power of AI, its reliability, and I believe we've got an ethical code. Singapore actually led in many ways with some of those principles that we can now apply to the safe use of AI. And therefore, this feels to me like a real breakout opportunity. And it's from that we're going to be able to identify patterns that have not been discovered before, dependencies that have not been properly appreciated. And I do believe you'll then be able to apply it both to consumers, to help them understand whether it's their own finances or their household needs, all the way through to economies and thinking about the dependencies that sit within a much wider and more complicated economic system, all hopefully for great use for the good. And of course, in the current environment, and I must perhaps round off on this, the ability to use scaled AI alongside both financial, personal, and health data, I think could potentially be another breakthrough area for us as we go into 2021. So, Jonathan, noting that there'll be some worried looks, I'm sure, amongst the rest of the panelists, perhaps I hand back to you and look forward to any robust challenge.
Oh, yeah. So, Matt, Sumant, your view of that being the most important thing for 21.
So I like this. I'm gonna dive in. Ben certainly went straight for the shiny gold object. I'm going to counter. I'm going for the wagon wheel manufacturing, because the question is who makes the most money, not who has the sexiest idea. So the thing that I think is going to be really interesting in 2021, in this secular shift to digital, what we've seen is a rush of traditional businesses and users to digital experiences. And there is a gap that exists in the market worldwide for enabling those digital experiences and connecting them to funds in a legal and a secure manner in every market. It takes different forms. So the investment thesis that we have that we're going to operate on is really about enablement of financial services, or what we would call sort of the enablers. And it ranges from issuer processors, neo processors, who are going to build API that are going to help people issue cards or credentials and rapidly put tools into play that can be used to either send or receive P2P or tap, click, or purchase, using digital wallets on one side, over to the other side, banking as a service. We see big moves from companies like Stripe moving into Stripe Treasury right now. That's because there's a need. People are in marketplaces, they're in messaging platforms, funds are beginning to pool, and people want to connect those back to their traditional banking relationships. And so whether you are a bank building a front end to be able to offer it to technology companies, or a technology company building an interface that can enable banking as a service, we see this as a really interesting space.
Okay, so Matt just went for his thing. We didn't really debate Ben's AI thing and go around, but that's
all right.
Fun. Yeah, but what I think about that, Jonathan, early 2000s, everybody was an internet company. Mid 2000s, everybody was a mobile company. Sometime a few years after that, everything was a cloud company. And now every company that comes to us is an AI company. So I think it's table stakes. AI is just another piece of the technology stack. And it's a very important piece of technology stack. I studied it in college, called neural networks, when it was neural networks before it became what it is today. So, and it's now cost effective enough to use. So I think pretty much any software company today will say that they're an AI enabled company in some way, form, or the other. So for me, that's, if there's a counter to what Ben said, it is exciting. It is something new, but it's kind of table stakes now. What Matt was talking about is also very interesting. You think about payments as a service or banking as a service, it's becoming more and more an interesting space for us to look at, more and more embedded into every application offering some service to a consumer will have some sort of payments embedded in it, we believe. Now, another exciting trend here in the US is real-time payments. I don't think that outside of the US people think about it as much, as because it's been there already. For me, the most sort of interesting thing to look at, which we've been waiting around for a long time, is emerging markets. And I really will focus more on India than anything else, because China, in my mind, is not an emerging market. It's a very well-developed financial services FinTech market, probably ahead of anywhere else in the world in some ways. But the Indian regulators have spent a lot of time putting frameworks in place where I think they're pretty much leading the world in terms of their thinking. And what we are seeing happen is still a market which is very hard to make money in. But there's more people adopting digital technologies and digital frameworks than anywhere else in the world. The adoption over this COVID cycle has been faster than I would say anyone expected. The amount of money that has been put into enabling connectivity by people like, I think everybody under the sun working with Reliance and Jio is unprecedented. And so I think between UPI and the BBPS and all the different sort of frameworks that have been put into place, that's a potential unbelievable market for FinTech in the next decade. That's the way I think of it. So I'd love to hear arguments against it, because believe me, there are arguments against it even in my own firm, where people are saying, are you silly? Are you a believer in stuff? You've been saying the same thing for 10 years. When is it going to happen? When is it really going to happen? But I think it's happening now. Back to you.
Okay. Anybody want to take that with Sumant?
Yeah. I'll drive in on the positive on that. I think, all good fun across. I think you agree AI is going to get built into a lot of things. A lot of platform enablers are going to be out there. The real question is, where are we going to offer new services to new customers in new ways? And the emerging market, broadly speaking, is the part of the world where we have the most growth. And I think that people have, I shouldn't say people, I think that a lot of companies that have looked at emerging markets have found it very difficult for a long time. But we are starting to see guideline parameters from regulatory standpoint that are making this look a lot more likely in the upcoming years. So I think it's a good sort of overlay to all of the things we're talking about.
And Jonathan, I think I better come back on the whole sort of table stakes piece, because I would argue it's the very fact that it's table stakes that means it's actually the most relevant theme for 2021, because that's sort of the point. Up until around now, it was sort of bleeding edge, poorly deployed, not fully understood, certainly black box territory, definitely not deployed at serious scale in large organizations. And with the benefit of both Matt and Sumant's observations, you now have this wonderfully connected and digital economy growing in many different parts of the world. And therefore, look, I obviously agree that is a huge step forward and very exciting for 2021. But I would argue that doesn't take you to the real new propositions. It doesn't give you the new revenue at scale, to Matt's question. It's the AI and the algorithms that sit beneath that data, that sit both at the edge and at the core, driving that understanding which hasn't previously existed, that then creates the value that Matt's looking for. And to Sumant's point, it's only through the connected networks, the growth of those networks, the cross-border silos coming down, that you actually truly get the benefit of artificial intelligence at the scale at which it can truly change lives and or industries.
I think I agree with all that. I'd just say I wouldn't know where to put my $1 to get it.
Okay.
I would just buy Google stock.
That's
right.
So
That's the world's biggest AI engine right there. I mean, it's been around for the longest time.
So we haven't really challenged Matt yet. So I'll take the first stab of it's not really a challenge. I'm obviously a big fan of the neo processing, banking as a service space, but as companies like Stripe get into it and sort of other larger companies get it, is there an opportunity to invest in new will there be enough room for new startups to get into this space? And that's a question, right? So I don't know if anybody else has a comment on Matt's theme, but that's one question that I have.
Yeah, I mean, I'll take that one just first really quick. I mean, sir, absolutely. What's great when you see a platform like a Stripe who has, incredible capability in terms of exposing things to developers and making them consumable, that is a huge step forward for, the industry as a whole. And, we Visa invested in Stripe, many, many years ago, not to pick a winner, but because we began to see that flow of access or enablement happening. Let's go beyond the Stripe. Being able to provide new services requires building up more vertical solutions. And I think there's a lot of space in the industry for people to build service-based interfaces that leverage underlying bank accounts or other things. And so if you think about, B2B payments, or you think about, healthcare, or you think about other sector or vertical specific plays, no one player is going to win in that. There's going to be a lot of room for platforms to build up.
Yeah,
Jonathan, just to change that a little bit. I mean, I think the thesis is understood. I think the challenge is the winners are few and far between. There are obviously notable exceptions, of course, of which Stripe is clearly one. That it is really for those who are earlier stage, finding quicker routes to distribution at scale that really, I think, marks out any particular company for success. And therefore, actually, it's that second order level of relationships that these companies will have that really will likely, for the vast majority, determine their success. And therefore, that's very difficult to spot at an early stage. And I do think the other perhaps counterpoint from an investment perspective is that there are now, I think, a lot of the larger, perhaps more traditional organizations who have very much taken the lessons of the last 2-3 years to heart and are really actively improving their own deployment of these technologies, very often in collaboration. But I think to your point, Jonathan, perhaps at the start, it's making the gaps very difficult to spot and the winners very difficult to identify. So it's not that Matt is wrong. I'm just not sure it's the investment theme for 2021.
I think the bigger question really is what makes for a fintech company. And I think that if you look at what the big tech players are doing, they're starting to understand and approach this as well. And if you think about Google or Facebook with WhatsApp, or Apple, even Amazon with their checkout now being distributed into the retail ecosystem, it's becoming a very crowded space, especially on the consumer side. I do think that the enterprise side has not been addressed in the same way. There's a lot of opportunity around treasury. There's a lot of opportunity around cash management, credit. insurance. I mean, you can take your sort of, in any and every one of these sort of buckets, which are, hundreds of billions, if not trillions of dollars of value, there's always going to be innovation available. I talked a little bit when I said, when we opened up about real-time payments, and, in different countries in the world, people take that as a given. But here, even in the US, 50% of transactions are still paper. I mean, it's still, clearing can take a day to a week to 2 weeks. I mean, so the amount of inefficiency in the system is still pretty dramatic. So there's a lot of work required to be done. And then if you move away from the world of just flows of money to the flows of data, and I think we all touched upon it a little bit, that is still, I think, an untapped opportunity. When we invest in, I'd say the last 7 years, we've been investing in companies that have been able to create a moat because of their ability to access data. It's less and less likely going forward. But for example, in a cybersecurity company we invested in called CrowdStrike, which is an endpoint security company, the ability for them to capture data centrally and then keep adding applications on top of it is what made them successful. We've been doing that again with fraud in a company called Forta. It's an Israeli company which is doing almost the same thing by capturing transaction data centrally. The volume of data over time gives them an advantage. So if you can come up with architectures that give you sort of you build advantage over time and volume and velocity, I still think there's a lot of opportunity to invest in these companies.
Okay, so we'll leave it at that. We'll let the audience weigh in, and I'll check the Q&A, and at the end here declare a winner. So let's move on from that, and the next question really is for Ben and Matt to talk a little bit about, especially for the startups that are watching here today, how fintechs and startups should look at collaborating with incumbents generally, and how startups should be thinking about it more specifically as it relates to Visa and Barclays. And Matt, why don't you just kick off from the Visa side?
Yeah, I'd be happy to. Well, I mean, I think the first starting point is that, and I'll speak for Visa because I think that just makes it, rather than being general, I think Ben can provide a really solid bank view. We have as a global network, we have a really large appetite for sort of being able to partner or enable as many different types of companies as possible in as many different places around the world. And so the first thing that we're going to focus on at all times is really trying to create a commercial or a programmatic approach to be able to engage as many companies as possible. And so, really simply, we have Visa Partner Program. It's a 100% digital onboarding, contracting, onboarding, and activation interface for working with Visa. And we, in the last sort of trailing 12 months, we had about 250 companies that came through that program and were able to activate or start working with Visa. So I think first thing I would say is, rather than pick up the phone and try to appeal as a company that can be invested in, I would say just get started. Let's begin to connect. Let's begin to work together, and let your volume or your growth tell your story. That's number one. I think the second one is that if we do get into sort of the investment track, here's how we look at it, and we have sort of four opportunities to work with companies. We can do an early stage venture investment, which could be in the $3 to $5 million range. We could do a late stage round where we put in a couple $100 million. We could do a commercial partnership where we work with somebody, through bilateral commercials. And then finally, we could do an acquisition, all the way up into very large size companies. So we always want to sort of see, touch, and engage with companies. We may not always make one of those decisions early on to do that investment. So the only advice I would offer is, think about the long haul when you talk to a company like Visa. We don't react or respond well to sort of like, if you don't invest in us now, we'll work with MasterCard or a category competitor, mainly because we don't think that any company very small should be entering into really exclusive relationships. In fact, we would prefer to see, an enabled company that works really well in the ecosystems and growing very quickly. We'd like to be preferred as a partner. We'd like to be, really a large part of your strategy, but we don't want to cut off your growth by, creating an artificial framework when you're a very small company. So generally speaking, just, play the long game with us, and there's many different ways that we can talk to over time.
Okay, great.
Thanks, Matt.
Ben?
Perhaps if I then come in on the bank and Barclays side, and I'll try and sort of speak perhaps to both industry and then a little bit specifically on Barclays. Look, I think the first piece of advice for those founders and startup and early stage growth companies is to be very thoughtful about the timing of your approach. It is very difficult for large corporates, particularly those that are regulated, to engage too early with early stage companies, particularly if there's an ask to either integrate into systems or indeed to be exchanging information sets. And so to Matt's point, being very thoughtful, it's not critical perhaps to get in right at the start, but just to build a longer relationship that you can call upon when you as a founder or an earlier stage company are ready for that step up conversation. So that's perhaps the first observation. The second one is there are different ways, however, that you can raise your profile. And this, I think, is an industry-wide one. Certainly applies to Visa. I'm sure many other corporates as well. We run, as Barclays, a number of incubators, actually, in the UK. We've got 27 called Eagle Labs in the UK, which are co-working places. But we also very much bring the network, and it's not an exclusive thing. It's very inclusive. Lots of corporate friends and family who will contribute their own time to mentor, sponsor companies, and just add whatever expertise they can to help the companies grow. And that is a great opportunity to just learn more and interact more with both ourselves, of course, but also many in the financial services and professional services world. We also have a FinTech specific incubator and accelerator called Rise, which many of you will know. And again, if that's it's a FinTech specific, that's another good route to build a relationship with us. The next piece I would say is be very thoughtful about understanding the process, whichever of the larger corporates you're talking to you about. There are some really difficult stories where conversations have taken a lot of founders' time, a lot of their energy, and actually it wasn't clear that, in fact, those conversations were being held with the decision makers and the sponsors who could actually make it happen within the firm. Certainly my own team try and help with that, as do obviously our networks in Rise and Eagle Labs as well. But if you're a founder and you're approaching perhaps for the first time, don't be afraid to ask the question. Could you explain how you fit into the organization? Are you someone that could sponsor perhaps a POC? What are your processes that would allow you to be able to say yes to that question? Are there other dependencies? Are there other people that I should be speaking for or speaking to? Or indeed, is it something that actually you just don't think is realistic right now? So you'll get, I hope, very honest answers to those questions, but you certainly shouldn't be worried about asking them, because it's in your own interest to save yourselves time. And then the final piece, Jonathan, I think is in and around the POC process itself. So let's say you've got the timing right, you've navigated your way through your organization, and you're then sort of thinking that you're ready to go. Don't forget, most large organizations, certainly the regulated ones, have a pretty onerous onboarding process. And that can often not be tailored to the early stage. We have certainly been trying, I know Visa have done the same, to try and make it as easy and as light as possible. But just making sure you've had good dialogue with your sponsor, you've identified the one person in the firm who can get it done for you, and have a very open conversation with them about, look, do all these questions have to be answered? Is there a shorter way of doing it? And again, just making sure that they've actually level set the questions to be appropriate for the type of company that you are on the way in. So I'll pause there, Jonathan, but those are some thoughts on how to engage in the way that I've just described.
Yeah, I think that's super helpful. And for those startups that are in the audience that are thinking about partnering with companies like yourselves, I think those are really helpful. That's helpful guidance. So let me change topics here. Especially over the last 4 to 6 weeks, we've seen this a huge amount of mega rounds going into the challenger and neobank space around the world globally. So it'd be great to just get some thoughts from the panel on this market. Maybe Sumant, you can sort of kick it off, and then It would be interesting to hear, from a large bank, from your perspective, Ben, on how you view it, and then obviously Visa's working with many of these companies, and sort of Visa's view on it as well. So we'll kick it off with Sumant.
Yeah, I don't know if I have a particular point of view just on neobanks themselves, Jonathan, because there are so many, and it's such a crowded space that I think in some ways the ability to raise capital becomes a differentiator for them. There's very little differentiating each one from the other. And so I think you see that in other markets where the pot of gold is very, very large, but there's a ton of people chasing after it. The competitive differentiation boils down to who can access capital, which is not a market I like to play in, but at least I'm seeing that happen. Having said that, the traditional banking value proposition or service has left a lot of people behind. And I would say that there's a lot, even in the US, a third of the population is kind of quote unquote underbanked or living paycheck to paycheck. And so there is definitely a need for new types of financial systems or new types of financial services that exist. Now, that's one component of it. The other is businesses and their ability to access capital has also changed. And I think these neobanks are trying to solve those kinds of problems by whether it's a different type of mix of customer, different types of services, a different way of delivering those services. And you could say that the opportunity is not just for a new entrant, it's also for the existing incumbents who are trying to solve this, whether it's Goldman, coming up with their own service or others. So I think it's a space in which, 5 years ago, one would have said, the branch office is going to die because everybody's going to access their banking through a cell phone, through a smartphone. That's kind of a given now. I think these are sort of evolutions in services that are happening all over the world. I think I have an 18-year-old daughter who's going to college, and I'm trying to figure out how to get her a credit card. It's not easy. Even that, I can't do that. So, if that's the sort of challenge in front of most people, new products and services are always welcome. There has never been as much liquidity in the business I am in the last 20 years. So the amount of capital available is also unprecedented. Many reasons. Of course, part of the reason is stimulus packages, printing money. Part of the reason is low interest, so you can borrow money, or there's no real yield anywhere else other than growth companies. Lots of different reasons. So whether you see the IPO market, which is also unprecedented, the amount of companies going public right now is I haven't seen in 20 years, or it's the private markets for companies with momentum. So I will make that caveat. You when you started out said that there's been a real shift in venture dollars from early stage to late stage. Companies that are showing momentum can raise money on their terms. Companies that have yet to show that they can add value, is very hard to raise money right now. It's very hard to convince someone because you can't meet someone. I mean, if I can't meet someone, they can't inspire me, how am I going to give them money? So there is this sort of bifurcation happening, which will normalize, I hope, over the next 12, 24 months, where innovation sort of with momentum is being rewarded, but innovation without proof is being, sort of drowned out. We don't see it happen. So anyway, that's my thought on this.
Right, yeah, agreed. Matt, why don't you go ahead and give your thoughts from a Visa perspective?
Yeah, I mean, I'll keep it brief. I think, we're really excited about what's happening broadly in terms of extending financial services, into new populations, adding new use cases, and neobanks are certainly a part of that. We think that I think some of the early runs in this were based on, funding rounds, and I think that the people that got in the lead were able to scale up. That said, we're seeing some differentiated services, and it was very difficult, many years ago for the capabilities of a bank to work across multiple countries easily, because you had to start ground up in building infrastructure. You worked within a regulatory environment, and then you would move to the next country and do the same. Today you have a cloud-based platform. You can roll around the world. You can offer digital services, and then you can comply with regulation where you choose to do so. And so that does create a lot of new types of competition, but it also elevates I think the experiences that banks will offer everywhere, because they're going to want to remain competitive, they're going to want to show they can do these things. So we see a general lifting of sort of all boats here. The only thing I'll say is that no individual bank has a right to sort of survive. So I think you're going to see brands, good banks, and let's say less good banks beginning to separate themselves. And whether they're neo or old, I think that holds true.
Okay, thanks. Ben?
Yeah, so just to jump in then. So look, I'm firstly a big fan of the neobanks. I think they've got great teams. I think they've come up with a fantastic laser-like focus on the customer, and I think as a result, you've seen some great user experience being developed. The big question clearly remains profitability, medium term, and the extent to which the neobanks can break through with models that do deliver not only value to customer in terms of experience, but ultimately to the bottom line. There'll be some that really do succeed, and then one or two examples already, and I think there'll be a number which don't get there. That's not to say that they'll fail, because I also see an opportunity for multi-banking. I think we see, generally speaking in the industry, examples of many customers who are perfectly happy having an account with a more traditional bank, and then they might use a neobank type account for budgeting purposes, and actually they use multiple bank providers for different purposes, and that itself may be a very sustainable longer term model. Or indeed it may point to the final theme, which is a longer term convergence and ultimately some consolidation, where some of the larger players who make progress in their own builds do recognize the talent that sits within the neobanks and look to sort of form a more longer term and more aligned strategic partnership, leading to some more uniform consolidation. So I think those are likely to be some of the themes that we see play out over the next 2 to 3 years.
And there's so many. I mean, what are the exit strategies for these? Is it banks? Is it like just you're going to have to go public? I mean, who's acquiring these companies? Anybody have a view on that?
I mean, I think right now there are actually very few acquisitions, and that's interesting. I do think that's likely to change, but I think at the moment it's just a little bit too early. The banks probably aren't close enough in terms of mindset to really drive hard on consolidation, and possibly the valuations on the other side aren't quite realistic enough to allow that to happen. But I do think it'd be interesting to Sumant's view. I do think over the next couple of years or so, you'll like to see that shake out. And you'll see a sort of a funnel which will be produced, which will then start to divide left and right. The handful that will really succeed to scale, and the rest who will be great partners, but not necessarily make it on their own.
Yeah. Okay. Matt, did you want to make a comment about that?
I'll date myself here, but I'll just say that you may remember that AOL got very big and bought Time Warner. So maybe the acquisitions go the other way around.
Yeah, true. That's a good point. Okay, so we're almost out of time. I will announce the winner, right? The winner is Matt Dill. The banking as a service, neo-processing. It is on fire. There's a lot of funding going on in the market, a lot of early stage companies. So
wagon wheels.
Yeah, and for your reward for winning is to make a little bit of comment on the Plaid Visa acquisition, but we may be out of time, actually. Unfortunately, we have actually run out. You were saved by the bell.
Very nice.
Thank you, everybody.
Very nice.
Thank you.
Thank you very
thanks, Ben.
much. Thank you.
Matt.
The pleasure all. Thank you.